This question assesses ethical decision-making under the IMA, Institute of Management Accountants, Statement of Ethical Professional Practice. The key issue is not simply the bidding process, but the conflict of interest and failure to disclose it. Key facts. The purchasing director awarded a contract to the lowest bidder. She had a personal interest in the winning bidder, conflict of interest. She did not disclose this relationship. She also promoted the bidder's experience, which may be biased. The core ethical problem is that personal relationships could influence professional judgment, even if the price was the lowest. Under IMA principles, professionals must maintain objectivity, integrity, and transparency. So the key concept tested is ethical value violation, objectivity versus fairness versus honesty. None, because a competitive bidding process was utilized. Incorrect. A competitive process does not eliminate ethical obligations. Disclosure is still required. B. Fairness, because she did not tell the truth about her relationship with the vendor. Fairness involves impartial treatment of all parties. While there is an element of unfairness, the more precise ethical violation is broader than fairness alone. C. Objectivity, because her relationship with the bidder could have impaired her judgment. Correct answer. Objectivity requires professionals to avoid conflicts of interest and ensure decisions are free from bias. Her personal relationship could impair impartial judgment, even if the price was lowest. D. Honesty, because she was not being truthful about the experience of the bidder. Honesty relates to truthfulness, but the main issue is not misrepresentation of experience. It is undisclosed conflict of interest. Correct answer. C. Objectivity, because her relationship with the bidder could have impaired her judgment. This question focuses on ethical responsibilities under the IMA Statement of Ethical Professional Practice, especially confidentiality and information handling. Key facts. Fan Club Incorporated prepared a budget for a new product, rechargeable fan. The budget includes sensitive strategic plans, such as aggressive advertising and production intentions. The product is not yet publicly known or approved for release. A management accounting staff member shared the budget with a distributor. The key issue is that internal budgeting information is confidential and strategic, and premature disclosure can harm competitive position. The ethical concern is therefore about unauthorized sharing of sensitive internal information, not pricing or legal outcomes. So the question tests understanding of the confidentiality principle in professional ethics. The budget has not been approved and therefore is not for publication. This is partially true, but approval status alone is not the ethical issue. Even approved budgets can be confidential. So this is not the best answer. B. The price has not been established, so expectations must be managed. This is irrelevant. The issue is not pricing uncertainty, but unauthorized disclosure of internal information. C. The staff member exposed the company to a potential lawsuit. While legal risk may exist, this is a consequence, not the ethical principle being violated. The question asks for the ethical conflict, not legal outcome. D. The employee should refrain from disclosing confidential information. Correct answer. This directly reflects the IMA principle of confidentiality, which requires accountants to avoid disclosing sensitive internal information to unauthorized parties. Correct answer. D. The employee should refrain from disclosing confidential information. This question is based on the IMA Statement of Ethical Professional Practice, focusing on identifying which ethical standard is not violated in a given scenario. Key facts. An accountant discovers unethical conduct in the organization. The accountant does nothing due to fear of retaliation. The key issue is passive behavior, failure to act, in the presence of unethical conduct. Under IMA standards, professionals are expected to act with integrity, objectivity, credibility, and confidentiality, and also to communicate or report relevant issues when necessary. However, the question asks for the exception, the one standard that is not violated. So we must evaluate which ethical principles relate to acting or not acting on unethical behavior, disclosure and communication duties, misuse of information. Refrain from engaging in any conduct that would prejudice carrying out of duties correctly. This relates to maintaining professional competence and avoiding harmful actions. The accountant's failure to act on unethical conduct could indirectly affect proper duty execution, so this may be considered violated. B. Refrain from using confidential information for unethical or illegal advantage. There is no indication the accountant misused confidential information. He only failed to act, so this standard is not violated. C. Communicate information fairly and objectively. Not reporting or addressing unethical conduct can affect fair and objective communication, so this is likely violated. D. Disclose all relevant information that could reasonably be expected to influence an intended user. Failure to act means failure to disclose, so this standard is also violated. Correct answer. B. Refrain from using confidential information for unethical or illegal advantage. This question is based on the IMA Statement of Ethical Professional Practice, specifically the escalation process for ethical issues and financial reporting problems. Key facts. An IMA member discovers a problem that could mislead users of financial statements. The member has already reported it to the immediate superior. The issue now is, when should the member escalate the matter to the Audit Committee or Board of Directors? The key concept tested here is proper reporting hierarchy and escalation path. Under IMA guidance, employees should first report issues internally. Escalation to higher governance bodies, Audit Committee/Board, is appropriate only when management fails to act appropriately or is involved in the issue. So the question is about identifying the threshold condition for escalation beyond management. He is the company's CEO and knows about the situation but refuses to correct it. Correct answer. If the CEO is aware and refuses to correct a material issue, there is no higher internal authority left within management. Therefore, escalation to the Audit Committee or Board of Directors is required to protect users of financial information. B. Reports to CEO, but CEO refuses to correct it. This is also a strong escalation trigger in many cases. However, the option is less precise than A, because it does not explicitly establish final internal authority or governance escalation necessity as clearly. C. Assures the member that the problem will be resolved. If corrective action is reasonably expected, escalation is not immediately required. D. Reports the situation to higher-level management. This is still within management and does not justify escalation to the board. Correct answer. Is the company's CEO and knows about the situation but refuses to correct it.